Welcome to Money Depth Insights. I'm the finance guide, Nell. Today we're going to talk about stock market myths that quietly keep people poor, not because the market is unfair or impossible, but because these ideas shape behavior in ways that prevent long-term progress. These myths are rarely stated outright. They're absorbed slowly through conversations, headlines, social media clips, and half-understood experiences. Over time, they harden into beliefs, and beliefs quietly dictate decisions. This conversation isn't about shaming anyone for holding these ideas. It's about examining them carefully, understanding where they come from, and seeing how they influence outcomes in ways most people never stop to question. One of the most damaging myths is the idea that the stock market is primarily a place to get rich quickly. This belief doesn't usually appear in such blunt terms. It shows up more subtly, in the expectation that investing should feel exciting, that good decisions should produce fast feedback, and that meaningful progress should be visible within weeks or months. When that expectation isn't met, frustration follows, and frustration often turns into abandonment. People conclude the market doesn't work for them, when in reality, they were measuring success on a timeline the market was never designed to satisfy. The stock market, at its core, is not a machine for rapid wealth creation. It's a system for reallocating capital toward productive activity over long periods of time. When people approach it with short-term emotional goals, they tend to overtrade, chase noise, and mistake motion for progress. The irony is that the desire to get rich faster often results in decisions that slow progress down or reverse it entirely. Wealth in the market usually comes from patience paired with consistency, not intensity paired with urgency. Another deeply rooted myth is that you need to be exceptionally intelligent or mathematically gifted to succeed in the stock market. This belief intimidates people before they even begin. They imagine complex formulas, elite insiders, and constant analysis, and they assume they don't belong. In reality, many of the most successful long-term investors are not defined by brilliance but by restraint. They make fewer decisions, not more. They avoid unnecessary complexity. They understand what they own, why they own it, and what would cause them to change their mind. This myth persists because complexity looks impressive. Simple strategies rarely make for exciting stories or viral content. But the market doesn't reward intellectual performance, it rewards behavioral consistency. Being able to stay invested, avoid panic, and resist constant tinkering often matters far more than being able to analyze every variable. When people believe success requires genius, they outsource their thinking, follow loud voices, and lose confidence in their own ability to learn gradually. Closely related is the myth that professional investors always outperform regular people. This belief leads many to assume they are permanently disadvantaged. They believe institutions have better information, faster systems, and insider advantages that make competition impossible. While professionals do have resources, they also face constraints that individuals do not. They must manage client expectations, adhere to mandates, and justify short-term performance. Individual investors, by contrast, have flexibility. They can invest slowly, ignore quarterly pressure, and hold positions indefinitely. The myth of professional superiority causes people to underestimate the power of simplicity and time. It also leads to constant strategy switching. When results lag, people assume they need something more sophisticated. They abandon reasonable plans in search of complexity, often paying higher fees and increasing risk without improving outcomes. Over time, this behavior erodes returns and confidence simultaneously. Another belief that quietly keeps people stuck is the idea that the stock market is essentially gambling. This myth usually comes from observing short-term trading, speculative behavior, and dramatic market moves. When people see prices swing wildly, they conclude outcomes are random. If it's all luck, why bother learning or participating? This perspective ignores the difference between speculation and ownership. Gambling is defined by negative expected value and lack of control. Long-term investing in productive businesses is neither. The gambling myth also encourages emotional detachment from responsibility. If outcomes are random, then losses are unavoidable and wins are accidental. This mindset discourages learning. It prevents people from examining what they own, how businesses generate cash, and how economic growth translates into shareholder value. Over time, treating the market as a casino justifies reckless behavior or complete avoidance, both of which limit long-term wealth building. Another common myth is that timing the market is essential for success. People believe they must buy at the bottom and sell at the top, and if they can't do that, they shouldn't try at all. This belief is reinforced by hindsight charts and confident commentary after the fact. What's rarely discussed is how unpredictable turning points are in real time. Even professionals with vast resources consistently fail to time markets accurately. This myth leads to paralysis. People wait endlessly for the right moment, while missing years of compounding. Or they jump in and out based on fear and excitement, often selling low and buying high. The uncomfortable truth is that time in the market matters far more than timing the market. Progress comes from participation, not perfection. Waiting for certainty in an uncertain system usually results in inaction. There is also a persistent belief that you need a large amount of money to start investing. This idea discourages people early in their financial lives. They assume the market is only for those who are already wealthy. As a result, they delay participation until they feel ready, which often means years later. What they don't realize is that early contributions matter disproportionately because of time, not size. This myth keeps people poor by stealing their most valuable asset, years of compounding. Small, consistent investments over long periods often outperform larger, delayed contributions. The market rewards duration more than intensity. Waiting until you feel financially comfortable before investing often ensures you miss the period when investing would have had the greatest impact. Another subtle but damaging myth is that diversification means owning many things without understanding them. People hear that diversification reduces risk, so they spread money across assets blindly. They end up with portfolios they can't explain, filled with overlapping exposures and unnecessary complexity. This creates a false sense of security. When markets fall, confusion replaces confidence, and panic becomes more likely. True diversification is not about quantity. It's about balance and understanding. Owning fewer things you understand well can be safer than owning many things you don't. The myth that diversification alone protects you leads people to abdicate responsibility rather than deepen understanding. Over time, this weakens decision-making and increases emotional vulnerability during downturns. Another belief that quietly shapes behavior is the idea that losses mean failure. In the stock market, losses are often framed as proof of incompetence. This belief causes people to avoid investing altogether or to sell at the first sign of decline. What's rarely emphasized is that temporary losses are not only normal but unavoidable in any system that produces long-term growth. Volatility is the price paid for progress. When people interpret volatility as failure, they react emotionally. They try to eliminate discomfort rather than manage it. This often leads to selling at the worst possible time. The myth that good investors never lose money creates unrealistic expectations and sets people up for disappointment. In reality, good investors lose money regularly on individual positions but manage risk across the whole system. There's also a widespread belief that the stock market is detached from the real economy. People imagine it as a separate world driven by speculation rather than productivity. This belief is reinforced during periods when markets rise despite negative news or fall despite strong fundamentals. Over time, people conclude that markets are irrational and therefore untrustworthy. This myth ignores the time mismatch between markets and reality. Markets are forward-looking. They reflect expectations about future cash flows, not current headlines. When people don't understand this, they misinterpret movements and lose confidence. They react to noise instead of underlying trends. This leads to poor timing decisions and reinforces the belief that the market is incomprehensible. Another idea that limits progress is the belief that investing should feel comfortable. People assume that if a strategy is correct, it should feel reassuring at all times. When discomfort appears, they assume something is wrong. In reality, discomfort is often a sign that you're doing something counterintuitive but necessary. Buying when others are fearful and holding through uncertainty rarely feels good in the moment. This myth conditions people to seek emotional comfort rather than long-term results. They gravitate toward consensus views and popular assets, often entering after prices have already risen. When discomfort finally appears, they exit. The cycle repeats. Over time, this pattern produces mediocre results and reinforces the belief that the market doesn't work. There's also the belief that information equals advantage. People consume endless content, believing more data will lead to better decisions. In reality, excessive information often increases confusion. It amplifies short-term noise and weakens conviction. The market does not reward those who know the most headlines. It rewards those who can filter signal from noise and act with restraint. This myth keeps people poor by distracting them from what matters. Instead of focusing on saving rates, long-term allocation, and behavior, they obsess over predictions and commentary. They feel busy but make little progress. Over time, activity replaces strategy, and learning becomes entertainment rather than improvement. Another deeply ingrained belief is that past performance guarantees future results. People chase what has worked recently, assuming trends will continue indefinitely. This belief is reinforced by charts that show smooth upward movement and narratives that explain success after it happens. What's ignored is how quickly conditions change and how often leadership rotates. This myth leads to buying high and selling low. People enter after confidence is widespread and exit when uncertainty peaks. The market, however, rewards those who understand cycles and avoid extrapolating recent history too far into the future. Recognizing this requires humility and patience, qualities that are rarely encouraged in fast-moving environments. A related myth is that the market should align with personal beliefs about fairness or value. People become emotionally attached to opinions about what should happen. When the market behaves differently, frustration grows. This emotional attachment leads to stubbornness and resistance to adaptation. Markets are not moral systems. They are aggregation mechanisms for expectations and capital. Believing the market should behave in a certain way leads people to fight it rather than understand it. They hold losing positions out of principle or avoid opportunities because they don't fit a narrative. Over time, this rigidity limits learning and growth. Flexibility, not righteousness, is what allows investors to evolve. There is also a myth that investing success comes from constant action. People feel pressure to always be doing something. They equate stillness with neglect. In reality, inactivity is often a sign of discipline. Most of the value in investing comes from a few well-timed decisions and long periods of waiting. Constant action usually increases costs and mistakes. This myth keeps people poor by encouraging overtrading. Fees, taxes, and emotional errors accumulate quietly. The portfolio becomes a reflection of anxiety rather than intention. Learning to do nothing when nothing needs to be done is one of the hardest skills to develop, but also one of the most valuable. Another belief that shapes outcomes is the idea that investing is separate from personal behavior. People treat financial decisions as isolated events rather than extensions of habits. In reality, spending patterns, patience, risk tolerance, and emotional regulation all show up in investing. The market doesn't create these traits, it reveals them. Ignoring this connection prevents improvement. People search for better strategies without addressing underlying behaviors. Over time, the same mistakes repeat under different names. Real progress often begins with self-awareness rather than strategy changes. Perhaps the most damaging myth of all is that wealth is built through single decisions rather than systems. People look for the one investment that will change everything. When it fails to materialize, disappointment sets in. Wealth, however, is almost always the result of many small, unremarkable decisions made consistently over time. This myth encourages impatience and dissatisfaction. It makes steady progress feel inadequate. People abandon reasonable plans because they don't feel transformative. In reality, transformation is gradual. It's the accumulation of disciplined behavior, not dramatic moments. When these myths are examined closely, a pattern emerges. None of them are about intelligence or access. They're about expectations, narratives, and emotional responses. They persist because they're simple and comforting in the short term, even though they're damaging in the long term. Breaking free from these myths doesn't require perfection. It requires curiosity. It requires questioning assumptions and observing outcomes honestly. The stock market is not designed to reward those who react the fastest or feel the most confident. It rewards those who can remain thoughtful, patient, and grounded in reality over long periods of time. Understanding this reframes investing from a test of brilliance into a practice of consistency. It becomes less about beating others and more about aligning behavior with long-term goals. When myths lose their grip, clarity replaces confusion, and progress becomes possible. The market doesn't keep people poor. Misunderstanding it does. And once those misunderstandings are addressed, the path forward becomes quieter, steadier, and far more accessible than most people ever imagined.